Good morning. Welcome to Chaikin PowerFeed, your daily market digest. Today is Friday, August 17th, 2018. I am your host, Dan Russo, the chief market strategist at Chaikin Analytics. Check me out on Twitter at DanRusso_CMT. PowerFeed brought to you today and every day by Chaikin Analytics in conjunction with StockCharts.com and StockCharts TV. Sign up to receive Chaikin PowerFeed for free at www.chaikinanalytics.com/PowerFeed TV. And before we kick things off, just a programming note, I am on vacation next week. Be heading down to the beach with my daughters. Nick Webb will fill in for me in this time slot at 9:15 every day. So as we kind of walk into it now, U.S. equities were higher in Thursday's trading on a positive turn in global risk sentiment. Telecoms and consumer staples led. So your two defensive sectors led the market higher yesterday. Technology was actually the biggest laggard on semiconductor and internet weakness. We're going to look at semiconductors in detail today, though the tech did still finish higher. Treasuries were little changed to slightly weaker across the curve. The dollar was stronger on the yen, but weaker against the euro. Gold down about 10 basis points. WTI settled up 70 basis points, bounced off the 200-day moving average. And since we've highlighted it so often this week, we're going to finish the week with it. Breadth on the New York Stock Exchange was strong, positive 3-1. Breadth on the NASDAQ was positive 2.4-1. But as we get to the desk this morning, futures are down slightly, about 10 basis points. Asian markets were mostly higher overnight, though China underperformed. It fell more than 1%. And European equities are on the defensive. Treasuries are bid with some curve flattening, and the dollar is lagging against the yen. The yen is the risk-sensitive currency. So when the dollar is lagging there, that's a sign of risk sentiment. And we're going to talk a lot about that today, actually. So as we kind of walk through it, S&P 500 traded up into resistance at 2840 yesterday. Actually traded to 2850 and failed. So support and resistance are being respected here. Support is at 2800, 2771, 2741, and then 2711 to 13 on the 200-day moving average. Resistance, as I said, comes into play at 2840 and then 2850 to 73, the all-time high zones. RSI does remain in bullish ranges, and Chaikin money flow remains bullish as well. So under the surface, the indicators that we like to see are lining up. What I think we're at this point in the market where actually you need two views, right? Your secular view, which is consolidation within an uptrend, likely to resolve to the upside. And then you need your tactical near-term view. And I think your tactical near-term view now needs to be one of being a little bit less aggressive, maybe being a little bit more cautious, just given seasonality and some of the trends that we're going to look at that I'm observing. Remember, Friday for Chaikin Analytics subscribers is key themes, and a couple of the key themes that I'm watching are raising some caution flags. So the S&P 500 rallied into resistance at 2840. There are signs of risk aversion in key relationships, and that's what I'm talking about. In particular, semiconductor weakness is a concern. Oil rallied from the 200-day moving average. We'll talk about that, and futures do, in fact, point to a lower open. Power bars, Dow 5-2 in favor of the bulls. S&P 500 saw some shift to the bullish side yesterday, given the 80 basis point move higher. 99 very bullish or bullish stocks for 64 bearish or very bearish stocks. NASDAQ still greater than 2-1 in favor of the bulls at 24-11. Small caps also seeing some positive shift as they, we'll call them an inline performer, outperform the S&P by 8 basis points. That's in line as far as I am concerned. But the big story is consumer staples. A very defensive part of the market led when we had a strong day higher. I think that's something you need to pay attention to. According to the Chaikin Power Bar, small cap stocks and large cap stocks remain somewhat bullish. Major indexes are mixed. Stock of the day, every day as a PowerFeed subscriber, we will send you a bullish idea based on our proprietary power gauge rating. And today's stock, Sonic Automotive, comes from the non-food retail wholesale group, which has been on fire. SAH, very bullish power gauge rating, closed at 21.25 yesterday, up 71 basis points, so a slight underperformer. Chaikin power gauge rating for Sonic is very bullish due to very attractive financial metrics and very strong price volume activity. We have a very bullish stock, strong trend, strong industry. However, I'm not in love with the setup here. Right, it's the type of name we want to look at. Right, there's no harm in ever adding it to a bullish watch list and waiting for the tactical setup to change. But number one, we're still lagging the S&P 500. Number two, we're closer to overbought than oversold. Kind of stuck in a range here. You can see the range-bound trading, and we're in kind of no man's land here between this 18 to 23 range. We're stuck right in the middle. Look, I think you want to pay attention to it. I think it's interesting. I don't think you need to get involved right here, especially when I just told you that in the near term, we don't want to be as aggressive given seasonals and some breakdowns in key relationships that I'm looking at. Add Sonic to a watch list, ticker symbol SAH. I don't think there's any need to get involved here and now. Checking out the sector movement over the last 5 days, and I think the top three tells the story. That is defensive posture. Staples, Utes, and REITs leading the way over the past 5 days, while energy, materials, and comms are the biggest decliners. Tech, middle of the road, down about 80 basis points. Discretionary, down over 1% in the past 5 days. So one of the key relationships that we do look at, we're not going to highlight it here today, but we're aware of it, is discretionary relative to staples. And when that's moving up, that's a sign of risk-taking in the marketplace. And right now it's consolidating. Discretionary had been outperforming relative to staples, and now it's kind of pulled back a bit, and it's consolidating. And I do look at this on an equally weighted basis. If you were a Chaikin subscriber, you're going to get my note this morning, and that chart is in there. However, we look at it equally weighted to kind of adjust for the Amazon effect within discretionary. But Utes, REITs, also healthcare, a defensive group. Our transportation services industry is the one that's in focus today, and I've liked transports. Remember last Thursday, I highlighted transports as an emerging leadership group. My stock of the day last Thursday was UPS. And what's interesting to me here is the power bar ratio is 16-2 in favor of the bulls. But this group has only outperformed the S&P by 80 basis points over the past 6 months. So you have this very strong power bar ratio. The group is currently ranked number 2 of the 21 subsectors that we look at. It was number 1 last week. So this is emerging leadership, 16-2. We want to be looking at names like Hub, Ryder, and Forward Air, all with very bullish, Chaikin power gauge ratings. We're going to dig a little deeper on one of those today. I think that Hub is overbought in the near term, so tactically doesn't make sense. But Ryder and Forward Air both look compelling on the long side. Let's take a look at Ryder here. Ticker symbol R, very bullish. Power gauge rating, strong trend, strong industry. Here's that ribbon at the bottom of the screen telling us where that rating has been. But just recently, just here in the beginning of August, market beginning to agree with our model. We're getting our personality change from underperformance to outperformance. Market and model in gear, dynamic duo in gear, whatever you want to call it. This stock looks compelling in the here and now. What I will tell you is that Forward, FWRD, has the same chart, but I'm only going to highlight one of them here today. But the setup in Forward looks just as compelling. Stock is closer to oversold than it is to overbought. Money flow, positive. Stock looks like it's made the turn above a rising long-term trend line, announced positive earnings for the past 1, 2, 3, 4 positive earnings surprises. Ryder is the type of name that you want to look at here and now. When I say, we don't want to be aggressive, that means we don't want to push the setups, right? Sonic didn't look that compelling. Ryder does. That's how you want to skew your analysis here in late August and heading into September. Trending, yesterday's S&P 500 movers and shakers. Walmart's earnings were enough. Positive surprise. Lifts that stock 9%. SYMC up over 4.5% on some activist-type activity. Boeing up 4.3%. That stock's been under pressure of late. It is neutrally rated. NRG up 3.5%. Plus is the very bullish stock that we want to keep an eye on. On the loser side of the coin, Chipotle down nearly 4.5%. NetApp's earnings weren't enough, down over 3.5%. Constellation down nearly 3%. Facebook under pressure. Internet names under pressure. Facebook under pressure, down 2.7%. I urge you to look at the ETF Social, ticker symbol SOCL. That has broken down. Take a look at some of the social media stocks. They don't look that compelling. something to be aware of if you're thinking of bottom fishing in a name like Facebook. Viacom, bullish stock down over 2%. Maybe want to take a look at as a bounce candidate. But as I said, we're not getting super aggressive here back half of August. The earnings surprise, NVIDIA beat by 12 cents. However, the street was disappointed with the slowdown in chips to the crypto market. That stock trading down about 3% this morning. As we said, Walmart beat by 8 cents. That was enough. AMAT, kind of the big deal as well. They beat by 4 cents, but it wasn't enough. They did not beat the buy side expectations, and that stock is trading off. And this is a concern of mine. You've heard me talk about how important semiconductors are. We're going to take a deeper dive here today because these two stocks being down this morning are going to exacerbate a trend that I see in place. Before the open today, Deere reported that stock is down 6%, and here they are. Semiconductors on the verge of a relative breakdown. Here's the SMH relative to the SPY. So the semiconductor ETF relative to the S&P 500. You've seen this chart before. Chopping, and now we're on the verge of a breakdown. Actually, you could say we are breaking down. Depends on how you want to draw the line. We're on the verge. NVIDIA being down today and AMAT being down today are not going to help things. Look at a chart like Intel. It's completely rolled over. This is important. Why? Because this relationship, this line right here, this ratio is more than 90% correlated to the S&P 500, and it tends to be leadership. Look when the range started. This consolidation range that we're in for semis relative to the market started back in the fall 2017 in the November timeframe, leading the market's top in January. So if you're a chart pattern person, maybe you can say that this is a head and shoulders, and we're now breaking the neckline. I'm not hugely into patterns, but I am aware of them. So we'll keep an eye out. But this is important. Also important, series of lower RSI highs, and now we may be shifting into bearish ranges. If this breaks down, it has bearish implications for the market in general at a point when seasonality is weak, August, September, and at a point when global markets are all in downtrends. I think this is important to pay attention to. Today could be an interesting day for semiconductors in general. High beta versus low volatility is another relationship that I look at as a sign of risk taking, and that too is sending a sign of risk aversion. This is the Invesco S&P 500 high beta ETF relative to the Invesco S&P 500 low volatility ETF, and what we can see is, a steady uptrend through the back half of 2017 before this too went into a consolidation, again, ahead of the market. That's why we look at these relationships, because the important ones for risk tend to lead the market. Semis relative to the SPY, high beta relative to low volatility tend to be leading indicators for the market because they are signs of whether investors are embracing risk or turning risk averse. And what you have here is a breakdown in the ratio below the 200-day moving average. And again, like the semiconductor relationship, a potential shift into bearish ranges for the RSI for momentum here. So I'm watching these two closely. Chaikin Analytics subscribers, these two charts are in my note today, as well as some others. I look at high yield relative to treasuries. That's been very, very choppy. As I said, I look at consumer staples, consumer discretionary relative to consumer staples. That's backing up a bit. I look at small cap. I look at small caps relative to the market, and we know that index is backed off and is starting to stabilize as the dollar has broken out. But it's something we want to be aware of. The key relationships that I look at are pointing to a slightly more risk-averse stance by investors. And finally, we'll end it with oil, which rallied off the 200-day moving average yesterday, as we said we were paying attention to. And it's following through a bit here this morning. Resistance now going to come into play at that broken line at $67. We are still below the 50-day moving average. What's interesting to me is that volume has declined as oil is sold off. Also, we haven't been able to become oversold based on the RSI. Money flow takes a dip into the negative territory, but the same thing happened back in June before rebounding higher. Ultimately, we're going to give the benefit of the doubt to the bulls in oil until that 200-day moving average and support at $65 breaks. So get powerful, profitable stock ideas and more. Sign up for Chaikin PowerFeed for free. ChaikinAnalytics.com/PowerFeed TV. I hope you all have a great weekend. I hope you all have a great week next week. I'll see you when I return from vacation. Happy trading. Happy Friday.